All right, guys, welcome back for another video. In this video, I'm going to try to make the case for why debt to GDP is the most critical statistic to understand when you're trying to understand what's going on in the broader financial markets, what the central bank is doing, what the Federal Reserve is doing, why some of the things they're doing doesn't necessarily line up with, what they're publicly stating. And I think debt to GDP is the most critical element to consider. And all the data here is very relevant. But for the purposes of this video, we're just going to focus on this debt to GDP number, as it is, in my opinion, the most critical number to look at because it represents the government's ability to finance itself. Right, when it's at unsustainable levels like this, the government needs to drive it lower, significantly lower, in order for it to remain solvent and not default. But we'll revisit that. But first, I want to go to the markets. And right here, I marked off the June 15th date. And so basically, you see the U.S. equities market rallying off that June 15th level in the face of real interest rate rises by the Fed and also threats of further interest rate rises. We also have the 10-year yield here. I marked off that same mid-June level. The yield on the 10-year note topped out at the same time equities put in a bottom and started rallying. But what's interesting is that the 10-year yield maxed out here, but into rising interest rates and the threat of further rising interest rates. So that's really unusual behavior. Why is the government 10-year yield rising? Why is the 10-year government yield falling when interest rates are rising? That doesn't make sense. It's one of those things where you see it and you go, okay, what does the market know that I don't know? Well, hopefully I'll make the case that the market is a lot smarter than we are. I think the market is very forward-looking, and I think the market is realizing these, this debt to GDP situation and front-running future actions of the Federal Reserve. So let's go back to that debt to GDP number. And in order for this number to mean anything, I need to put it in some type of historical context. Basically, at the beginning of World War II, or actually at the end of World War II, debt to GDP had risen to 110%. And anytime you have a serious world war or, a war of any sort, that's always financed through major debt issuance. So the government issues an incredible amount of debt to finance the war, and you wind up with these debt to GDP ratios that are well north of 100%. In the case of World War II, peaking at 110%. So that kind of puts the problem in perspective, because right now we're at 130%, which is way above what the issue was during World War II. And really, I would argue the Federal Reserve's goal is to get that number down below 100%, or hopefully even much lower than 100%. I think their target would be like 80%. So they've got a long way to go from here. Basically, during the World War II era, you had a situation where you had financial repression. The government ran negative rates down very low to delever their balance sheet and get that debt to GDP lower. And the traditional methods that people had used for centuries to protect themselves from inflation, like holding gold, those were banned. U.S. citizens couldn't hold gold during this period. And the equities market was in a prolonged bear market. The bond market was also, bond investors were getting killed because of the negative real rates. So you had a situation where savers couldn't escape the financial repression. The only thing that savers could do was eat dirt on account that it was the patriotic thing to do at the time. At the peak of the post-World War II sovereign debt bubble, debt to GDP rose to 110%. To put that in perspective, we're trading well above that, 130% today. The Fed successfully dropped debt to GDP to 70% by letting real interest rates run negative for a period of several years following World War II. Now, in 2022, the U.S. is a dual deficit country, spending more than it receives in taxes and importing more than it exports. This is referred to as a negative capital account country. In order to delever the government's balance sheet, the government must be able to borrow cheaper than the nominal GDP growth the expansion of debt creates. This balance sheet, the balance sheet of the central bank must rise as needed in order to absorb the amount of government debt the public refuses to purchase at the government's artificially depressed interest rate. Again, I'm trying to make the argument that the Federal Reserve ultimate goal is to get debt to GDP down from 130% toward a more manageable level. In order to do this, the yields on long-term debt instruments such as the 10-year Treasury note must be lower than the growth of GDP. If the 10-year note yields 2% and GDP growth is 6%, there's a negative 4% real yield. However, GDP growth has contracted over the previous 2 quarters. So at this point, with the GDP contraction we've seen recently, uh, yields need to go deeply negative in order for the government to delever and to get that debt to GDP level down. And I believe that's what we're seeing in the bond market right now currently. The one scenario where this, could be effective with the government issuing massive amount of stimulus is if the stimulus is directed into activities that, directly promote the growth of GDP. That's a situation where you could get this deleveraging and debt to GDP down to 80% and still get an increase or at least recovery in the GDP contraction. I believe that's what the government will ultimately do. And remember, it's not QE itself or the purchasing of bonds that's directly inflationary, but the issuance of debt by the US Treasury that's then monetized by the quantitative easing program by the Federal Reserve. Again, that's a little bit of a nuanced thing. It's not that important to know. What I think, you know, is important to understand is that the government will increase spending to delever its balance sheet while trying to funnel that spending into areas that they believe will also have an impact on GDP. Right? That's how China basically went on a crazy run for the last few decades with that exact strategy. They basically, engage in massive financial stimulus, going injecting credit directly into their economy in a way that's a little bit different than the U.S. markets, because you have to remember that in China, there's no such thing as private capital markets because all the private companies are owned by the state. So the credit injection is not the same as it is in the U.S. And not reflected on the government's balance sheet in the way it would be in the U.S. Right? Any spending that's monetized in the U.S. needs to be slapped on the Federal Reserve's balance sheet, and the balance sheet must increase to uh, monetize that spending. But of course, in China, it's not the same. But what China did do effectively was they were able to channel that credit expansion into things that drastically expanded their GDP. And that, I believe, I mean, of course, there's many variables, but I believe that's the reason why China is what they are today. And I believe that's what our government is going to try to recreate. So that may be in like the form of, infrastructure bills, giant infrastructure bills, hoping that, you know, public infrastructure will increase the efficiency of the economy and increase gross domestic product. I think you'll also see push into energy production, primarily green energy, but just with the energy crisis we're seeing currently, probably now even just energy broadly, right? The government issuing debt, giving it to public and private companies to bolster their domestic energy production would be the most sensible thing to do in a way that you could spend money and issue debt and grow GDP at the same time and delever your balance sheet. But one other twist in this scenario is that in order to do that, in order to bring debt to GDP down lower, someone needs to buy bonds, right? And we've already established that bonds are, if rates are negative, then bondholders are going to lose money. They will lose money if they hold to maturity. There's no question about it. It's considered, you could describe it as a return-free risk. Um, Now, normally, before the COVID crisis or leading up to the COVID crisis, you had a situation where basically foreign demand for US treasuries was up north of 40%. So foreigners are roughly buying 50% of all US treasuries issued at auction. Now you've seen foreign demand for US treasuries drop from roughly 40% of all demand down to 8% and falling quickly. This has really been heightened by the seizure of the Russian forex reserves as a result of the Ukrainian war. The US Treasury froze Russian central bank assets and the assets of other important financial institutions conducting trade with Russian banks. Foreign countries can no longer ignore the risk of seizure that exists in the US Treasury market or other dollar denominated markets. This is the most relevant among countries that have positive capital accounts with the US, like China. China has spent decades trading real goods for pieces of paper. They need somewhere to put these excess dollars, and they cannot use it to purchase their own currency because the size of the transactions would drive up the value of their own currency and reduce the competitiveness of their exports. As a result, China and other similar countries have historically saved in US treasuries, but now the treasuries are no longer a safe haven for their savings. These countries would naturally be looking for an exit, right? Because they saw the Russian forex reserves being frozen and stolen, and now they realize that suddenly that's not a safe place to store savings. But because of the size of their capital accounts, China can't simply start dumping US treasuries on the market without collapsing the markets. A more practical solution is to just let the debt reach maturity and roll off the balance sheet. Now, I looked into the weighted duration of all bonds held by foreign asset holders, and it's roughly 17 years. So today is, August 2022. Uh, you can see this problem that I'm talking about in lack of U.S. Treasury demand accelerate as we get closer to that 17-year mark, and it'll get exponentially worse as these treasuries roll off and start reaching maturity. There just won't be any organic demand for buyers. And again, that 17-year number is not just Chinese maturities, but just foreign maturities in general. So I think their plan would be to let those U.S. Treasury maturities roll off their balance sheet, reach maturity, and then but they still have a capital surplus account with the West, and so they need to direct those savings into different dollar denominated assets, whether that be Bitcoin, gold, or commodities. Again, commodities are all priced in dollars. But the reason why they would be channeled into Bitcoin, gold, and commodities is because those three are resistant to seizure, right? They're bearer assets, can't be stolen. And ultimately, this gets back to the debt to GDP ratio and how the Federal Reserve will ultimately have to step in and be the buyer for those bonds that the government will have to issue to delever their balance sheet to get debt to GDP down from 130% down to 80%. I would argue that this is what they were trying to do all along, but politics, in the US, there's a political election coming up. So there's a little bit of posturing, political theater that they're going to raise interest rates. But I would assume that after the November elections in America, you see the political pressure roll off. The Federal Reserve and the government together can step in to the rescue to the economy, issue massive fiscal stimulus bills, and then the government or the Federal Reserve can resume its quest to reduce the debt to GDP from 130% down to 80% roughly. And ultimately that'll be a positive thing for risk on assets. Now, one thing that's worth mentioning is that the Federal Reserve has claimed that during this period in June and July, it would roll off or would sell assets from its balance sheet. Well, it hasn't really done that. The balance sheet has basically remained steady, despite them saying they've significantly reduced their balance sheet, which is just not true. But what I think is, may actually cause them to pivot even before the elections is this right here. This is the rate of change in CPI. So as you can see here, and this is very important, the rate of change, right? You can see here that the rate of change peaked in June at 1.32, and that's what they're looking at. But with this rate of change declining in July, you could say that prices have started to cool off, and the Fed is getting very close to being able to declare victory on inflation, say that their interest rate rising regime has raised rates and fought inflation. But as we know, energy prices are still parabolic, especially in Europe, in pretty much every developed country. Again, it doesn't really matter what reality is. It just matters that, the Fed is putting on a political theater so that they can appease the masses. Now, will they pivot before the elections? I mean, that's, unfortunately, nobody can time those type of things. But what we ultimately know is that the Fed will print because, you know, at the end of the day, they need to keep the government solvent. Right now, debt to GDP is at extremes that is really pushing the limits on, where you could go. I mean, as you go further, um, the system just gets increasingly less stable. So as they, if this is true, then, hopefully when the government issues new debt, they'll be issuing new debt to you know, channel that into productive enterprise and the type of enterprise that would raise national GDP. But as we've seen, governments are not exactly the best allocators of capital, so they probably won't end up doing that. Maybe to a minor degree, but I think what you can really count on is the massive uh, stimulus and massive fiscal spending by the U.S. government that you'll see after the elections. Um, Again, this is not a prediction. Well, I guess it is technically a prediction. But again, timing with these things are very, very difficult. And I think if anybody gets anything out of this video, it's not necessarily the timing of it, but to understand the reframing of the difference between what the Federal Reserve claims that its goals are and what its actual internal goals are as it relates to funding the U.S. government. Anyway, I hope you guys like this video. If you guys like it, just leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.